Is it okay to invest in cash? This is Bill Scheid from Applied Finance Research, and that's the question we're going to take a look at in this video. This is a question that's often talked about in the retail investing world, and it's a question we sometimes get about our monthly asset allocation systems because there are times that our systems invest heavily and sometimes even entirely in cash. So let's take a deeper look. To begin with, let's take a look at what the retail investment world says. Do a Google search on the topic of this question, and it won't take long until you find many variations of the same beliefs that generally say something along the lines of investing in cash because you expect a weak stock market is like trying to guess what will happen in the future and will generally cost you in the long term. And instead, you should temper the impulse to flee for safety, and implied in that is the idea of buying and holding for the long term, no matter what. So where does that leave us? What are the implications of these beliefs? These beliefs essentially leave us in a catch-22. On one hand, we're afraid of bear markets and we don't want to see our portfolio take a big hit in the next market crisis. So we don't want to just sit in equities and buy and hope forever. But on the other hand, if we move to cash, then we might miss out on market opportunities. So we don't want to move to cash. We don't want to sit in equities. We don't want to move to cash. That's the catch-22. And that's a difficult position to be in. It's the situation that many buy and hold investors find themselves in. It looks like an intractable situation given the beliefs that we looked at on the last slide. But there are three critical questions that we could ask ourselves, the answers to which could get us unstuck and help us reframe our market beliefs while also making a huge difference to our investing results. Those three questions are: how do we know when to move to cash? How do we know when to move back to equities? And what are the specific quantifiable long-term results of decision making in these two areas? If we could answer these three questions, that would be huge. But how do we answer these questions? Well, let's begin with our first two questions. Number one, how do we know when to move to cash? And number two, how do we know when to move back to equities? So how are we going to answer these questions? We're going to use two very powerful approaches to help us with the answers. First, we're going to apply academically rigorous market concepts that have been studied and tested in the research literature for decades. And the second is we're going to apply systems thinking. So the academically rigorous market concept that we're going to apply is the idea of a simple moving average. And some of the earliest academic works on moving averages go back to those of F.E. James Jr. in the Journal of Financial and Quantitative Analysis. Excellent research has also been done by Yingzi Zhu, which looks specifically at the use of moving averages on asset allocation. There's also the work of Rowdies et al., Vinicius et al., and also the work of my mentors, Dr. Ken Long and Dr. Van Tharp. In terms of systems thinking, we're going to apply a disciplined, rules-based approach to build a simple investing system, or strategy as you may prefer to call it. And the rules are this: we're going to hold the S&P 500, invest in the S&P 500 when it's above a given simple moving average, and we're going to invest in cash when the S&P 500 is below that same given moving average. And as part of that disciplined rules-based approach, the frequency of our decision making and analysis will also be systematized, and we'll make an evaluation on the last day of every month. Now, let's move to question 3. What are the specific quantifiable long-term results of decision making in the areas of knowing when to invest in cash and when to invest in equities? So this is a backtest I generated using etfreplay.com. It's the primary tool I use for backtesting and implementing all of our monthly asset allocation systems. And in this case, I've asked it to test the rules we just looked at a second ago. This backtest goes from December 31st of 2007 to September 7th of 2023. So it includes the financial crisis of '08, the COVID crash of 2020, and everything in between. So the graph on the left is an equity curve where the vertical axis is percent return and the horizontal axis is time. The green line is the backtest of our rule set, and the blue line is the S&P 500. On the right, we see that our rules returned 383% for this period, while the S&P returned 311%. Volatility is the annualized standard deviation of daily returns, and we see that the system had almost half, just a little bit more than half of the volatility of S&P 500. So in sum, the system has a greater return than the S&P and on a lot lower volatility. Here we see that our rules-based system had a compounded annual growth rate of 10.6%, while the S&P had a growth rate of 9.5%. We also see that the S&P had a drawdown of minus 52.3%, and the backtest had a drawdown of only 26.7%. So here we see a greater return on about half of the maximum drawdown. Now, as a point of interest, we're comparing our rules to the buy and hold return of S&P 500. However, in reality, most retail investors don't buy and hold just the S&P. They usually have some type of mix of stocks and bonds because they're trying to avoid the drawdowns associated with being 100% in equities, which, as we see here, can be pretty significant. A 52.3% drawdown would definitely be enough to keep most people awake at night. So to get a sense of a more realistic retail buy and hold performance, ETF Replay has a benchmark that they use called the All-World 60/40 benchmark. It's a portfolio of diversified holdings invested 60% in equities and 40% in bonds. Here's what the buy and hold stats look like on that. The compound annual growth rate is 5.1% on a maximum drawdown of minus 34.7%. Now, what's interesting about these numbers is that in comparison, our system's return is double the 60/40 benchmark, and the system's maximum drawdown is about 25% less than the 60/40 benchmark. Or to language it even more simply, the rules-based system beats the return of the S&P 500 on a drawdown 25% less than that of 60/40 buy and hold. In my opinion, that's huge. The system beats the return of the S&P 500 on a drawdown 25% less than that of 60/40 buy and hold. As a proof of concept, that's huge. I mean, isn't that what every retail investor wants? I want a return that beats the market because most retail investors never do. And I want it on the least drawdown possible because that's what keeps people awake at night. And note that we did that with some very, very simple rules. Now, mathematically speaking, a really concise and clear metric related to what we're talking about here is return to drawdown ratio. When we look at those numbers, it breaks down like this. The system has about 2.5 times the return to drawdown ratio of the S&P and more than 4 times the return to drawdown ratio of buy and hold. As a systems researcher, I personally like return to drawdown ratio as a way to compare a system or a strategy to the S&P 500. I find it's a basic and simple measure of risk and reward and of the value of a system or a set of rules beyond what I could get if I just buy and hold the S&P 500. I mean, buying and holding the S&P 500 is an actual option. Buy and hold is what many people do. But for me, if I'm going to run a monthly asset system, then there's got to be value beyond what I could get with buy and hold. The downside to the S&P 500 is the drawdowns. The upside is the return. That's the basic mindset of the investing public. Everyone wants the return, no one wants the risk. That's the crux of the catch-22 that we've been talking about so far. And return to drawdown ratio is a very simple way of calculating what we're talking about. So for me, when I see a return to drawdown ratio that's 2.5 times the S&P and more than 4 times the 60/40 buy and hold, that's a clear indication of the value of a system or a strategy or a set of investment rules. So in summary, is it okay to invest in cash? The answer we've arrived at is yes, if we use academically rigorous market concepts and systems thinking to answer the 3 critical questions that we've looked at here. The results that we looked at in this video are just one example of many systems that we teach at Applied Finance Research. And for more information about our systems and how to invest with our systems, visit us at appliedfinanceresearch.com. Thanks for watching and happy investing.